Corporate finance practice problem using OneNote. Stock rights investing scenario. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab down in the 1724 Stock Rights Investing Scenario tab. Also note, when using OneNote, look at the Immersive Reader tool. Our practice problems will be mirrored in the text area, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information then up top, calculations on the right and on down below. We're looking at a stocks rights types of problem. Once again, if you want a more basic problem to kind of intro into stock rights, take a look at a prior presentation where we go into that in a bit more detail. Here we're looking at investment scenarios related to them. Remember the general idea for the stock rights: corporation trying to generate capital, wants to issue shares in order to do so. Shares have already been issued and are outstanding, so therefore they might want to give the current shareholders a benefit or discounted price, possibly with the use of the rights in order to do so. Once the rights then are out there, there's going to be a time frame as opposed in terms of the declaration of the rights to when the rights are going to be expired. And then there's going to be the idea of what's going to happen over that time frame to the value of the stocks, the number of shares that are going to be out there, and this concept of having now the rights, which could be thought of as separate in and of themselves from the value of the stock itself. So taking that into consideration, we're jumping in here and we're imagining that we have a cash to invest of $10,000. And so we don't actually have the stock at this point in time. We're thinking about investing the stock, and the stock we're thinking about investing has a rights offering that has taken place as well. So we then could think about investing in the rights or investing in the stock. We have kind of our option at that point in time. So the rights offered per share are 1. The rights need to buy share at a discounted price. So in other words, if you were to exercise the rights, then it would take 5 of the rights in order to purchase 1 share of stock at the subscription or discounted price of $85 to get that 1 share. The market price X rights is going to be 97. And then we have our options here. If we invest in the rights and market price for X rights goes up to 101, what's going to happen? If we invest in the stock itself and the market price for the X rights goes up to 101, then what's going to happen? And then we'll see if there's a decrease and there's a loss, what would happen. So in other words, we have our $10,000. We're thinking at this point in time, we have the option then to either invest in the rights, or we could invest in the stocks themselves at the X rights price of the $97. That X rights price then could fluctuate. What would be the impact if we were to invest in one or the other at that point? So we have the value of the rights. Let's calculate. We have the market price, and this calculation is down here. We're at the rights valuing during the exercise of rights period, which is going to be the stock price minus the rights subscription price divided by 1 plus the rights needed to buy 1 share. So if we go back up top, we're going to say the market price is now 97. Notice that's the X rights price. The cash subscription price we're saying is 85, the difference being the 12, and then the denominator is simply going to be the number of rights needed to buy a share, which in this case would be 5. So the 12 over the 5 is going to be the 2.4. Let's put that in the calculator just for the fun of it. 12 divided by 5, 2.4, $2.40. So the rights that would need to be purchased then, the rights that could be purchased, we have $10,000. If we say, hey, we don't own the stock, we're going to invest in the rights themselves. So they're going to say, all right, $10,000 purchasing the value of the rights, which we're saying is the 240. That means that we can purchase then 4,166 about. Note that there are roundings. You can't, you're not going to be able to purchase half of a right or something. So you'd have to round up or round down depending on. But we're going to keep the rounding here. So we're going to say 10,000 divided by the 2.4. That's going to be the 4,166 about, or 4,167 about. So the shares that we can buy, what if we took our $10,000 and we want to buy the actual shares X rights? Then they cost $97. So we can take the $10,000 and invest them in the shares instead of buying the rights. and we could take our 10,000, say just by the shares, X rights. This would be 10,000 divided by 97, which would be about 103 shares. Once again, there is rounding involved here. We can't buy partial of a share, so if we wanted to round it to 103, take off the 09 and so forth. So then we're going to go down and say, okay, well, what would happen then in a scenario where if we invest in the rights and the market price for the X rights stock goes up to 101. So the price goes up to 101 and we bought the rights. Then let's see what would happen. The market price is at 101. We compare that to the cash subscription price, which is 85, and subtract that out. That's going to give us 16. And then the denominator, once again, is 5. We're using this formula to calculate this again with the update to the market price for the X rights. And that's going to give us the value of the rights at the 3.2. The 3.2, so we're simply taking then the 16 over the 5 to give us the $3.20, the 3.2. So then we have the cost of the rights. How much did the rights cost us? We're saying, well, we invested in the rights as we calculated up here, 2.4 on the value of the rights. So the difference between that, 2.4 minus 3.2, or 3.2 minus 2.4, is going to give us that 80 cents, the 80 cents at the difference, multiplying that times the number of rights purchased. We said that we could have purchased 4,166.67 rights. So we're going to say, and this is about times the 4,167, about gives us about the 3,333 on the upside there. What if, on the other hand, we invested in the stocks themselves? So we're going to say now the sales price of the stock went up to the 101. If we didn't buy the rights, but rather the stocks at the X rights price, the 101 minus the 97 would be 4. That would be the difference. And then we purchased how many shares? We purchased the 103 shares about. So 4 times 103 would give us the 412. So obviously plugging that in the calculator just for the fun of it, 4 times 103 about gives us then the 412. So so you could see here that it kind of amplified the gain there if there was an upside on the change and we invested in the rights as opposed to the stocks themselves during this X rights time frame. What if there's a loss, though? Things go down. So if we invest in the rights and the market price for the X rights goes down to 80, what would happen? And so on with the rights investing in the stocks. So if the market price for the X rights went down to 80, and we compared that to the cash subscription price, once again doing this calculation up top of 85, now we have a negative difference of 5 for the numerator, denominator being 5. That's the number that would need to buy at the discounted price, but the price is no longer discounted, and you can't really have a negative number there, so that's why we would have to put 0 here. So you divide that out, you get -1, but you can't really have a negative number, so the value basically we'll say is at 0. The cost of the rights then is at 2.4, so we had the 2.4 on the rights, so what's then going to be our loss? It's going to be the 2.4 minus the 0, or the -2.4, and multiply times the number of rights that we purchased. And we said that we purchased up top with our $10,000 that about 4,166. So we'll then say that -2.4 times the 4,166 about will, of course, be the loss of that $10,000 investment. What would happen on the preferred stock side? On the preferred stock side, we're saying we have the $80. So we had $80 on the sales price now compared to the cost, which we could have purchased them for, which was the X price, the price X rights, 97. That difference is a loss of 17. 17, how many could we have purchased? 103 about. So we purchased about 103 of them. We calculated up top. And therefore, we have the loss down here of the 1,753, which is the 17 times the 103, about 1,753. So you can see on the downside, if things were going to go on the downside, we kind of amplified the negative impact on the downside if we invested in the rights as opposed to with regards to the stock.